markets go up and down. That's the natural rhythm of investing. But in such a downturn situation, what we've seen in the last 5 months, we've seen markets falling.
Every year you will see markets fall, and that is what we have seen. The only thing is that this downside, we have seen more pain. At Cedrus, what we generally recommend investors is, and we believe in the all-weather strategy. There is more pain for equities, so I don't see that the markets have corrected. If you don't require the money, there's nothing where you need to panic.
We did hear a very renowned fund manager speak about the volatility in mid and small caps, and he did even mention that investors should have SIPs done in mid and small caps only for a period of more than a decade.
So I think it's come during the wrong time. Mid caps and small caps, this space typically has a tendency. What happens is that you will see that in a very short period of time, you will see a very steep fall. What we have seen in recent times is a lot of money moved from fixed income to equities, and there is where actually investors saw more pain. So I think going forward, I feel quality large caps may outperform the markets. Long term, I think nothing has changed. The India growth story is intact.
A very warm welcome to all our viewers to this edition of Knowledge Series. Markets go up and markets go down, which is the natural rhythm of investing. Of late, we have seen markets to fall, and the overall decision making gets impacted because of the uncertainty and the negative sentiment that gets created in the market. Today I'm very excited actually to hear further on this from none other than Mr. Nilesh Bajaj, who's our founder director. He will share his views on how should one position themselves in these falling markets, what are his views particularly to equities going forward, and what one should avoid doing when markets are falling, and how should one strategize their investments. So without further ado, let us hear from none other than Mr. Nilesh Bajaj.
A very warm welcome, sir. And today we all are very curious to hear from you that how should one position themselves in the falling markets. I mean, markets go up and down. That's the natural rhythm of investing. But in such a downturn situation, what we've seen in the last 5 months, we've seen markets falling. Decision making becomes even more crucial, and navigating through these challenging times becomes very important. So coming from there, my first question to you is, given the prolonged downturn in the market, what are you advising to investors, and what is your strategy at Cedrus in these current situations?
So thank you, Unnati. In fact, if you ask me, this kind of a downside is not something which is very new to the markets. Every year you will see markets correct, and that is what we have seen. The only thing is that this downside, we have seen more pain because we've seen a lot of mid and small caps fall. They have fallen by more than 20% actually. But in this kind of fall, most important thing what an investor should ask is whether I require a loan. Because if you see actually what has the market done, okay, last 5 months the markets have fallen, and it has eroded 1 year of return. So any investor who has come in the last 1 year, he has seen his portfolio not performing. But at Cedrus, what we generally recommend investors is, and we believe in the all-weather strategy, which means that you need to have investments in all other asset classes also. If you don't require the money, there is no problem. And I'm sure, like I told you, that it's only been 1 year where the markets now, if you see the returns have been lower. But any investor who's come before that, there are returns which are there on the table even today. So I think first thing what we are advising at Cedrus is that stick to your asset allocation. That is a very important thing. There is more pain for equities. So I don't see that the markets have corrected. I expect the markets can correct more also. The valuations are not reasonable. So the thing is that if valuations are not reasonable, there is not going to be a lot of support which we can see in form of that where the markets will stabilize. But all said and done, I think equity is an asset class where you don't invest for 1 or 2 years. Okay. At Cedrus we do financial planning, and when we do financial planning, we typically tell investors, whoever wants to invest in equities, their goals are typically more than 5 years. So any investor who's got a goal of more than 5 years, they have nothing to worry. because they don't require the money right now. So if you don't require the money, there is no problem. But definitely anyone who's invested for a time horizon of 1 year, there is pain. There can be more pain in the future also. Now the reason, like I told you, is that the valuations are expensive. But apart from that, if you see, the earnings are also not supporting. So we have seen the second quarter results, which were not as good as expected. Historically, we have done quite well in the last 2.5 years, when we saw the markets also rallying. The third quarter results also have been subdued. So valuations are not supporting the markets. Now coming to what are the specific events which have happened in the last 2-3 months, which can help stabilize the markets. I'm not trying to tell that the markets will increase from here right away, but they will help it stabilize. So one, it's been basically, the budget has been a very consumer-oriented budget. It's been a budget where there will be more money in the hands of investors or in the hands of middle class, to be precise. They can either spend, which will again, help the economy, which has actually seen the GDP, which has been, which has decelerated in recent times. You will see that support can come. On top of it, it can support the markets also, because there will be more money in the hands of investors, which can get invested in case if there is no consumption which is happening. Second thing is, finally, this is what we have been expecting at Cedrus since the last 1.5 years, that there should be a rate cut. We have seen yields fall, they have cooled down. The 10-year G-Sec yields have fallen. And what we expect is that finally, as RBI has cut rates, we will see more rate cuts happening in the future. That also is going to help the market stabilize. The third thing basically is to do with FII selling. Now the FIIs have sold just because in US the interest rates have gone to 4.5%. Okay, approximately 4.5%. We have seen 3 rate cuts in US also. In case if the rate cuts continue, which I expect will continue in US, you will see that the equity premium for India will come back. So you can see FIIs come back in case there are more rate cuts in US. So our basic strategy in this kind of a scenario is stick to your asset allocation. Do not panic. If you don't require the money, there's nothing where you need to panic. And you need to see that you do objective-based investments, which is basically linked to your goals. Right? So this is what we have been recommending at Cedrus.
Very rightly said, sir. I think having the right mix of assets is something what will help investors, and investors should maintain their asset allocation, because, as you said, there could be a possibility of volatility to sustain for another couple of months. You were just mentioning about the fall in mid and small caps, and we did hear a very renowned fund manager speak about the volatility in mid and small caps, and he did even mention that investors should have SIPs done in mid and small caps only for a period of more than a decade. So what is your perspective on it, and what are your views on that, specifically the broader markets?
So I think it's come during the wrong time. That's the only thing, but I don't think he was totally wrong. In the sense that if you actually see at Cedrus, the last 1.5 years, we have been telling investors that mid and small cap space, specifically the mid cap space, looks overvalued. Unfortunately, the markets do not behave, rationally, and we have seen a rally in the mid cap space in spite of rich valuations. Now there has got a little bit of background to it actually. You must have heard that there has been more than 1 million accounts, demat accounts which got opened in fact. So a lot of investors did invest in this space. Typically mid, small and micro space, you have more of retail participation. Okay, there is where the retail participation comes. The FIs generally don't invest in this space. It's typically in the large and to some extent mid caps. So there has been a lot of inflows which we have seen through these direct equity investments by investors in this space. Second, it's been all around the space that the SIP book, that has been increasing month on month. So again, there is a lot of retail money, and specifically in SIPs, which happened in mid and small cap, there was a lot of money which was driving prices in this space. But the writing was very clear on the wall, and it's not now, but it's been since last almost 18 months now, where this space has been very expensive. Okay. Mid caps and small caps, this space typically has a tendency. Typically what happens is that you will see that in a very short period of time, you will see a very steep fall. And that is what we have seen, in fact. That in the last 2 months or 2.5 months, you have seen this space take away all the returns of the previous 1 year because the fall has been so steep. So one, like I mentioned, that valuations were expensive. The time was not right for him to tell that because already there was panic in the markets, and this has only exaggerated the panic. But he was not totally wrong when he said that there is a pain in the mid and small cap space. Coming to what we are doing at Cedrus. So last 1.5 years we have not invested in this space specifically. We have not given very large allocations in a bullet form of investments in this space. So mid, small, we have not invested very large allocations we have given. The reason was that we had this thing that it is an expensive area right now. It is in the expensive zone. But coming to SIPs, we have continued with the SIPs. When we do financial planning and in financial planning, we invest in mid, small only for a time horizon of more than 10 years.
Right.
So we will not tell an investor to invest for 5 years in mid and small cap. So internally, we have a process in place where anyone who's got an objective or goal for more than 10 years, we make them invest in this specific space of mid and small caps. Coming to again, this pain which we have seen, I think this we have seen previously also. So, historically, we've seen that in 2008 when there was the credit crisis, again, in 2016-17, we saw prolonged 3 years when mid and small caps didn't give any returns. There was a zero return or negative return in this period. But historically, there is one more thing which is positive, that you take any period of 8 years, okay, any period of 8 years. If suppose an investor came at the peak of the 2008, before the crisis started, or at the peak in 2016, or around that period, on an 8-year basis, a SIP is never given a negative return. They have got returns. So to some extent, it is a little bit of, I feel, an exaggeration that we should stop SIPs. I don't think that's the right approach. Last thing is, an investor has to ask himself. He has to look at his own portfolio. Whether has he invested everything in the mid and small caps? Because if he's invested in mid and small caps, all the investment, then he's not done the right investments. In fact, you typically will invest in flexi cap funds, multi cap funds. You will invest in large and mid cap funds. So you will have exposure to the large cap funds also. There will be a small portion of your investment, or maybe a little higher portion, which is there in this mid and small cap space where you will see pain, in fact. So my advice to investors is definitely not to stop SIPs. I think there have been a lot of panic calls which we have received that should we stop SIPs in mid and small caps. It is a volatile asset per se, but over a longer period of time, and I'm sure when you have invested taking it into account that you don't require this money for a longer period, you will get your returns.
Right. So investing in mid and small cap is very much important. Tenure becomes very much important when we are allocating funds in the broader markets. And as you mentioned, the 8-year cycle that very much goes in sync with saying that one should look for investments in the mid and small cap space over a period of 10 years, so that the volatility can be least impacted. And you were also mentioning that one should have different categories of investment, and well allocated portfolio will help the volatility to least impact. Coming from there, sir, positioning of the portfolio, churning the portfolio also becomes very important in a market fluctuation. How have you tried to allocate portfolios or reallocate portfolios during the current volatility that we see?
This is a very interesting question because, like I mentioned, we have stayed away from mid and small caps, specifically, when we had to do any kind of a bullet allocation. We have invested in SIPs and we continue to do that. But how have we positioned, citing that the markets were expensive? I always give this example, your investment should be like a cricket team. So I give an example of the Indian cricket team. Typically, the pitches change. So pitch is the market. Okay. So you will have a pitch where, it's a batsman's pitch. Okay. So what we saw till September of last year was a batsman's pitch, where actually equities, any kind of equity, be it mid cap, small cap, large caps, most of them gave good returns. Okay. So it was easier for investors to get returns in a market like that, where you saw broad-based rally, in fact. But now the pitch is different. The market is different. And what we have been suggesting investors is that you need to have a more defensive approach. So you need to be, so we have invested a lot in multi-asset funds, specifically multi-asset allocation funds, which do allocate to gold, silver, as well as they allocate to international markets. And there is a good component of fixed income, actually. So that is one product where we have done huge investments in the last 1 year. Second has been the asset allocation space, where again the investor can invest in this space, taking into account that the fund manager can change his equity allocation based on the valuations of the markets. So in case the markets are expensive, the fund manager has reduced his equity allocation. And in case the markets become reasonable or cheap, he will increase his equity allocation. That is one more strategy where the investor will see that his capital more or less is protected. Definitely they have also fallen, but they fall less in compared to the way the markets have fallen. Now this is related to strategies in mutual funds. Apart from that, other asset classes. So, always an investor should be well allocated in different asset classes. And he should not chase one asset class. What we have seen in recent times is a lot of money moved from fixed income to equities. And there is where actually investors saw more pain because, in the last 1 year is where actually, investors lost money or have got very low returns. So you should have allocation to gold, okay, gold and silver, precious commodities. Apart from that, like I mentioned previously also, in the last 1.5 years, we have been recommending government securities. So a 10-year G-Sec, citing that the rate cuts is something which is imminent. We are expecting that more rate cuts will happen. The bond yields have already started cooling off. And there investors can end up in a double-digit return in case if the yields fall from here on also. But what are these asset classes? These asset classes, I call them as shock observers. So these are the defensive ones. These are the round rubbers of the portfolio. So they are not going to give you great returns, but they will see that in this kind of a market, they will protect your capital and give you a reasonable return, actually. So I think this is how we have positioned the portfolios. Even an aggressive investor does have multi-asset in their strategies in the portfolio. As well as, we have seen that we have allocated to gold as well as government securities so that their capital is protected. Apart from that, the last thing which I would like to say is basically is within equities. We have seen quality did not perform. So the likes of HDFC Bank, Asian Paints, you have so many high quality stocks which actually till September underperformed. But there was earnings growth happening. So there the valuations have become reasonable. So I think going forward, I feel quality large caps may outperform the markets and the broader markets may actually underperform over a period of time. So I think that is how we have positioned the portfolios for our investors.
Right. So having a defensive strategy is something which will help one to navigate through the current market situation, which is quite volatile and dynamic.
Not exactly defensive strategy because you may have an aggressive investor who's got a time horizon of 10 years.
Right.
So I can't go and tell him that you put everything in multi-asset and in government securities. But what I'm trying to tell is that you should have allocation to it. You will see pain in mid and small caps. You will see more pain. Okay. But that is not going to affect your overall portfolio when you have these strategies in place. Because they will basically, be like your shock observers for the portfolio, which will see that they fall less and your overall portfolio then falls less.
And you were just giving your outlook on how debt as an asset class will, be performing with the rate cuts that we saw. what is your outlook on the Indian equity markets in the near term and the short term and the long term?
Long term, I think nothing has changed. If you ask me seriously, the India growth story is intact. We are one of the fastest growing economies even today. Our GDP growth must have come down a little bit, but yet we are one of the fastest growing economies. What has happened in recent times is, I think, like I told you, the corporate earnings have come down. They have actually cooled off. So, we were seeing a healthy 20% corporate earnings growth, which has come down. Okay. So markets will start looking at that. I think the market's focus right now is, how the corporate earnings are going to behave. And if we don't see corporate earnings improve, you will see that the markets may be in this zone or may fall more over a period of time. But now there are a lot of positive things also which have happened. In fact, so like I just mentioned about the budget, I mentioned about the rate cuts. The cooling off of, Fed has cut rates 3 times. There is expectation of more rate cuts. So these are some positives which will help stabilize the markets. But there is going to be a sector rotation and stock rotation. What did well previously, that does not mean they will keep doing well in the future. So when earnings have risen, but if prices have risen more than the earnings, you have seen those stocks fall more. But wherever earnings have risen and prices have either risen with the earnings or have actually risen lower than earnings, you will see that there you will see a kind of there they will not fall, or there will be a re-rating which will happen over there. So definitely we are seeing some spaces where you will see growth will come back, which we have not seen previously. So what didn't do well were high quality stocks, typically in the large cap space. And maybe because earnings rose but prices didn't rise in line with earnings, you will see that there you will see some kind of a cushion where they can rise in spite of markets not doing well. But overheated spaces, sectors as well as equities, where you have seen huge price rise, but earnings have not stuck to those to the rise in prices. There is where you will see that there is more tailwinds.
Coming to my final question, sir. During these kind of volatile situations, we do see the behavior of investment and the market sentiment to be quite negative, and there could be some mistakes which the investors would make, and the decision making could get hampered because of the overall sentiment being weakened in the markets. What do you feel are the key mistakes that investors should particularly avoid and keep in mind while making any decisions regarding their investments?
So I will give about 4 to 5 pointers. I'll put it in a pointer format actually. 1, do not stop your SIPs. Okay, you have invested in SIPs for a longer period of time. In fact, SIPs will do well because you will invest at lower levels. So SIPs always work on averages. So when you are investing month on month, you will see that you will get a better rate today because the markets are falling. So that is the first thing, do not stop your SIPs. Okay. Second thing is, do not chase returns. I think the mistake which a lot of investors do, and it has happened in the last 2.5, 3 years, and specifically last year, where on a rear view mirror approach, investors were seeing big returns in equities, and specifically in the mid and small cap space. And they went and invested in that space. In fact, so do not chase returns. Have a clear objective that when do you require this money, and invest only in that form. So if you require money for a period of 2, 3, 4 years, I don't think so equity is the right space to be. But definitely for a longer period of time, equity is one of the best asset classes. Third thing is, just for example, I give this thing that in February of last year, when I looked at the returns on a government security and I looked at the return or FD also, and if equities, investors didn't want to invest in this asset class, fixed income. Coming forward 1 year from now, the best performing asset class apart from gold, actually government securities and FDs have done better than equities on a 1 year basis. So one mistake what people generally do is, when they panic, they move out of this asset class which is fallen more, which is given lower returns, and get into an asset class which has done well in the last 1 year. That is one more mistake which a lot of investors do, which I recommend them that you should not do. I avoid these mistakes because maybe when the markets rise, you will get those returns, but then you have already changed your asset class where you will not participate in that rise. So please do not change your asset class when the markets have already fallen. The fourth thing basically is do a proper financial plan, do a need analysis whenever you invest. I think most of the investors, when they come and invest, they only invest for returns. But I think if you have a clear time horizon and you bucket your investments in different forms, if you bucket them in different objectives or in different goals, you will end up having a right allocation. In fact, so you will be allocated not only in equities or international equities, but you will have fixed income, you will have asset allocation, you will have multi-asset, you may have gold, okay, based on your time horizon. So that is one thing which is there, that whenever you invest, see that you have a clear time frame for each investment you do and bucket them based on your time horizon. The last thing which I would mention, and which I have been telling is, as advisors, we understand risk. We are supposed to understand risk, actually. What investors understand is always returns, actually. So when you ask an investor, what is your objective? He wants a great return. As an advisor, we need to see that the portfolio is well cushioned to these kind of corrections. These corrections will keep happening. Every year you will see the markets fall at different levels. Last year also we saw the markets fall again from end of last year to today. We have seen the markets correct deeply, and they may correct more. But the important thing which I always recommend an investor is that see that you, instead of trying to chase returns, okay, you have an allocation in place which will help you get a better return in equities over a longer period of time. Coming to one advice which I tell every investor is that if you treat, if you respect equities, equity will respect you. So it's a two-way thing. You invest in equities, and if you don't respect it, which means that you trade, you get out at the wrong time, you panic, okay, you will end up losing money. But in case if you respect equity, you stay invested for a longer period of time, have the right behavior in place, I'm sure you will get a great return, because Indian economy is going to do well in the future. There is nothing which has changed between now and 6 months back, except that in the short term, there has been certain parameters where you have seen a lower growth. And that is the only reason why you have seen the equity markets correct. So if you stick to that, I don't think there is any problem with equities, and you will end up making a great return in the equity markets.
Very rightly said. I think a lot of key takeaways for our investors, to watch out while planning their investment strategies during this volatility that we may see for a couple more months. And as you said, one should not stop their SIPs, and investors should do objective-driven, investments, keeping in mind the tenure. I think that is something what was a very valuable input that we all have got today. So thank you very much, sir, for your key takeaways and for the valuable insights. I'm sure all our investors, will watch out for these small little things what you mentioned, which will help them strategize and navigate through these dynamic times that we see ahead of us.
Thank you.
Cedrus Wealth Partners, orchestrating distinctive wealth management proficiency since 2007. We deliver transparent, unbiased, and comprehensive investment solutions. Today, we manage more than 3,000 crore rupees in assets, proudly serve over 1,000 families and 3,000 individual investors, and with a team of 26 experienced professionals, we help our clients achieve their financial goals. Our 360 degrees wealth management approach integrates investment planning, risk management, tax optimization, and legacy planning. We focus on the 4 essential pillars of financial planning to create a strong foundation for your financial future. Our advisory process is mutually exclusive and collectively exhaustive. We provide uncomplicated advice. No ULIPs, no NFOs, and no structured products. Our portfolio offerings include managed equity solutions for superior risk-adjusted returns, novel offerings including hidden gems that provide pre-IPO and niche investment opportunities, and alternate investment solutions like private equity, real estate, private capital, and multi-index investment strategy. From humble beginnings in 2007, Cedrus has grown with a commitment to innovation, excellence, and trust. With a global presence in key cities, Cedrus continues to redefine wealth management with innovation and trust. Discover the Cedrus difference. Your financial success is our mission. Contact us today to begin your journey.